Hello everyone, I'm Dr. Stock and this video is for entertainment purposes only. Today I want to share with you a look that I have taken at inflation and where I think it's going to go in 2022 based on what we've seen historically. I think based on what I have mapped out here for you, I'm going to share it with you. I think it actually makes 2022 a little bit intriguing, and maybe the Fed isn't going to have as much impact as they're going to let on to have. With that said, I do think that they're going to take action. So I do have a lot to share with you, so I'll move on with the video. So let's get ready to rock. All right, welcome back. If you like and appreciate the information that I have for you here today, just go ahead and hit that thumbs up button. If you have other details that you would want to share with me or anything that you would like to shout out with, even words of support, encouragement, whatever it is, hit me up down in the comments. While you're down there, also take a look into the description for my referral links for Moomoo and Webull. You can sign up, deposit your money, and get your free stocks. I'll get free stocks through referral. And then last thing, the Patreon, if you see more of what I have to offer, there is a referral link for the Patreon down in the description. So with that said, let me tell you what I have to share with you. So I took a look at CPI data, and I know that CPI is not the end-all be-all, but it is a major market influence right now. And after receiving that 7% CPI read for all items year over year from December 2021 or from December 2022 December 2021, where do we go from here? Is it going to stay just as high as it is? Is it going to be something that changes rapidly for us? I think we have some patterns in the data that are worth taking a look at. So I'm going to share those with you and also talk about sort of how I see 2022 going for us. All right, so what you're looking at here are the CPI data values that we have. Everything on here is taken from historical values from the CPI data, except for this last column that you see here, column V. That is one, they are my own projections that I've put up. They don't really have a whole lot of basis outside of sort of what I see from the rest of the table and how I feel like it's going to go. If we wanted an actual value for how it's believed that 2022 is supposed to end, this number down here would be 3.8. I just think that that's a bit of an overshot from what we have based on everything else that I see in the data. I think that that's a higher number, and I think that if we end up lower than that 3.8, that it's going to be better. I do think that we're going to end up lower, and I'll talk about that more soon. So with that said, what we're seeing in this first table that I've made, like I said, these are all CPI data values that I've highlighted here for you. The ones that you see in blue are the lows from within. This is 2002 here in column B, 2003 is right here, 2004, and so on, all the way up to 2021. All of those are historical values that you're looking at. So in the blues are the low values and the yellows are the high values. And the reason that I did this is that I wanted to see, since these are year over year numbers, when we have high numbers, are they adjacent to the low numbers that we have? And you can see between, for 2003, that directly adjacent to the high value for 3% is 1.1 and 1.7% on either side of it. And when you look, they are at least nearby each other, and that leads me to the second chart. I'll get there soon, but here again you can see low and high side by side to each other. These two are close to each other, close to each other, close to each other, and so on. In 2008, with the financial crisis that we had that hit in October, we started to see an inflection downward for the inflation values, then going negative in a little bit in 2009. Before jumping back up in 2010, and we just keep on seeing that pattern go along. So what we have here, fast forwarding to 2020, in January before the pandemic really hit, we had that high number of 2.5, 2.3. Things were sort of going okay, and then March, oh boy, March hit, and that really dragged things down, and that was history for the rest of it. Directly adjacent to it for 2021 is this low number of 1.4, and then we ended at 7.0. So what I did was I assumed that January was going to be a lot like December and just put in 7% for my estimate, figuring that it was going to be a high number compared to this relative low number that we have right here. And then similarly, I figured that inflation would be going downward throughout 2022 for a lot of reasons that I can get to throughout this. Right now, I'm focusing on the tables, but then you see it going all the way down to this 3%, a relatively low value because of the relatively high value that's right next to it. And these are year over year numbers. So if we go down to this next table that we have, So how this is scaled is that in green are the lowest values, in the bright red are the highest values, and the shading in between are those in between values. So the brighter the red that we have, the higher the inflation number within that calendar year, according to the CPI data, and the brighter the green is the lower that we have. And when you see the pinks and whites and light greens in the middle, those are when we have those middle values. So I did that because up here in this first one, we had to look directly adjacent or nearby. Down here, with the coloring that we have, we can see this area that we have of higher inflation coincides with these areas that we have for lower inflation for year over year. And then down here, higher inflation is adjacent to lower inflation, which is adjacent to higher inflation. So it just sort of bounces around on us as we look at that. And if we go to 06, there's the brightest red right next to the brightest green. And for the most part, you don't get red right next to more red, at least not bright red next to bright red. Here we have a pinkish color next to a pinkish color, so sort of middle values. And I don't think that that's all that surprising. If we look at the bright red, it's right next to a bright green next to bright red. So year over year numbers, when we have the extremes, it makes it easier for the next year to go the opposite direction. So when we look at 2012, this is one of the very few times that we go bright red followed by bright red, and we're at 2.9 and we're at 2.0, and those are really typical values that we have. So 2.9, not astoundingly high. 2.0 is very, very middle. As a matter of fact, that's the inflation target that the Fed is hoping for, is around that 2% mark over the long run. So for these to be consecutive like that, it's not really all that concerning. Even here, when you look at more bright red, which is still 2%, next to this bright-ish red of 2%, that it really doesn't totally break the pattern for what we're looking at. If we go more extreme over here to what we have from 2020 to 2021, we had the brightest at 2.5, and then the bright green right next to it at 1.4. And as we get out of that, the brightest red that we have is 7%, which is the most recent reading that we have. And so I think next to this green, because they are such low numbers, that's what's going to allow January of 2022 to also be a relatively high number. Even if it's not 7%, I still think it's going to be relatively high. And then moving on through there, since these numbers are only increasing, we call that monotonic behavior. Since they're only increasing, I think that throughout 2022, black swan events aside, if everything goes as planned, we have supply chains constraints that are easing. We also have the fact that the money printer is not going like crazy anymore. That's something that is going to also mitigate the amount of inflation. The Fed is actually starting its bond tapering. It's talking about the rate hikes, which I also refer to up in here. Consumers could get more conservative. We also have the federal unwinding of its balance sheet, which is supposed to be slow at first and then pick up speed over time. So that could spill over late 2022 into 2023, and we could get some frugal consumers that might slow down that buying, which isn't necessarily good for the growth of the economy. It's not necessarily great for the stocks that we have, but it should be something that would ease the inflation. So let's go down to the third one that I have here. So this one is similar to the one that's above, only instead of going within each year, this is across all the years from 2002 to 2021. So the brighter the red is the highest, or the 7% is the highest that it is out of the entire table. And then the brightest green that we have is right here at negative 2.1% in 2009. So that's following that relatively high number of 5.6 that we had in 2008. So after that financial crisis hit us, and we were in the depths of that one. So right here in the brightest red that we have for the 7%, this is out of 240 data values and is the highest number that we have. And I realize that the pandemic wreaked absolute havoc for supply chains, for the markets that we have, that there was a lot of financial need. The money printer just kept on going. So we have to come to terms to that, and I really think that a lot of that stuff has been priced in over time, and I really think what also enabled all of these high values that we have are the relatively low values. You can see with some of these brighter green values that we have, these are fairly low values compared to what we have in 2021. So I think that these numbers made it easier for these to already be higher. And then on top of that, put out the fact out that there was a lot of consumer demand and supply constraints that we had going on. And like, this is just going to be things that drive inflation. And so that you see that inflation occurring more and more. But also being that these are very high compared to everything else that happened in the 21st century for us, then I think that makes it easier for 2022 to go even lower as we have it for 2022 moving forward. Then it's going to start off relatively high because we ended 2020 at 1.4 and we began 2021 at 1.4. And so I think that we're going to be relatively close when we start January. So if you look at the end of 2019 is 2.3, beginning of 2020, 2.5. 1.9 to end 2018, 1.6 to begin 2019. So to end at 7 and begin at 7 or somewhere close to 7, I think is about right. And then month over month changes are typically gradual unless some big event occurs. So what I have here is that we have a gradual change for the first 3 months. That's the first quarter of 2022, and then a big jump down by the time that we start off the second quarter of 2022. And that's because we went from 2.6, a big jump up to 4.2. Well, if you look at what we went 1.2% down in 2020 from March of 2020 to April of 2020, we went 1.2% down, making it even easier to make this big jump. And if you look at the relatively large jump from February of 2021 to March, that's 0.9%, so almost a full percent up. When we look at it that way. So it's not really a gradual change like we had, but over here we also had a 0.8% downward. So even though it's not really looking at it month over month in the correct way, we can at least see those patterns in the data that for the most part in typical years, we have gradual changes. And anytime you look that we didn't see that gradual change, when we saw that jump also gets reflected in the subsequent year. So that's why I have the jumps that I do, that at first it's 0.2% going from January to February, and then 0.3% February to March, and then we at 1.5%, which is relatively large jump because of the relatively big jump that we've had from March to April. About the Fed timing. The Fed timing right now, what are they trying to do? They're trying to end the bond buying, the taper off the bond buying by March. And honestly, I think that's strategic. They need to make themselves look good. So they're choosing March in order to make themselves look good, because if they take action in March, hey, we stop this, and also if they do a rate hike in March, which if I scroll back up here, I have that question mark for the rate hike. If that's when it happens and we have a big movement downward in inflation, the Fed looks good. They look like they have things under control. There's a lot of faith that can go back to the Fed because of that. And then we could also, as we go through, the rest of this has pretty much been smooth. Actually, right here, 5.4 up to 6.2, that's another pretty big jump, and then a fairly big jump here as well. So maybe I should massage these numbers a little bit more to accommodate for those somewhat larger jumps that we have, that it should be relatively smooth in the middle here, and then maybe some bigger jumps that we would have. Maybe it's written here yet that I have to adjust that, but the Fed is going to take all the credit that they can. I think using the word transitory for so long, it made them seem a little bit less credible and less in control, and so they're trying to get that control back and build their credibility back by addressing inflation and being hawkish as they are. And the more aggressively this happens, with or without them. So if they're taking action and we get reduced inflation because of it, or seemingly because of it, they can take the credit for that. And then they look good. They look like rock stars. Hey, we are getting inflation under control. We have this thing covered. Things are normalizing, when really I think some of this is happening on its very own just by the tapering alone and the world getting back to its normal self. Hopefully the pandemic is no longer referred to as a pandemic, that even though the coronavirus is likely here to stay, that the strains over time become less virulent, that we become better able to handle the ones that are. I think that we've grown a lot from March of 2020. I remember just being in my house and wiping down my groceries and going absolutely insane because we didn't know just how deadly the virus was. Like the people would showing up with severe symptoms because the people, and we were very biased towards that because we were only seeing the severe symptoms. Plus we had the media, really selling it because they all wanted the views too. It makes it very difficult to tell. But over time we got to see, even though it is something to be taken seriously, it's something that we can manage, and it's a matter of managing it along the way. And can we do better, can we do worse, and at what level, at the individual level, at the hospital level, at the research level, at the government level. Those are all things that I think we can do better with. Let me show you just real quick the distribution of the CPI data over the last 240 months. I did check out the standard deviation on this, and it's about 1.41% standard deviation. So that means that within 1.41 of the mean, either direction, so up to about 3.6 and down to about 0.8, we should have about 68% of our data in there. So more often than not, that's where we find it. Now, since we are to the upside, we'll talk about the upside. After 3.6, you go up to 5. So 5%. After 5%, you only have about 2.5% of the data, statistically speaking, above that 5% mark. So above 5% for inflation, that is really very rare to see it up that high, and I doubt that we're going to see it up that high very much longer. I think between the Fed taking action, which I think will help reduce the inflation, but I think that it's also going to reduce naturally on its own, looking at the year-over-year numbers like we have been. Even if we look at the month-over-month, we went up 0.5% from November to December times 12, that's 6% for the year. So that's already less than the 7% that we're looking at the year-over-year number. So I think that we're that we're getting to a really good place with inflation. Not that it's good right now with the numbers are the way they are, nor do I think that prices are going to really come down all across the board, broadly speaking, for the CPI anytime soon. But I think that they are going to slow down by how much they are going up. I think that it will normalize, and it's going to take, if we're shooting for that 2% target, I don't think that we hit it in 2022. I think that we do hit it during 2023. I think that there's going to be a lot more smoothing that happens, and I think we're going to return back to the middle of this where most of our data are. So what about the markets? For the markets, I think that 2022 could be that sort of rough year, and I think that we're overdue for a correction. I don't see a market crash taking place, and should it crash, I think that is something that we would recover very quickly from. So when we look at this, a date to keep in mind, and you can just type in FOMC meeting schedule for 2022, and you get these dates. So January 25th. So the markets could be rough leading up to that time, especially the week thereof. So Monday, Tuesday, and even into Wednesday, as we're waiting for Jerome Powell to speak. We could see a market sell-off, or we could see the market. And the reason that I say sell-off is because they are already a bit high. They have been a little bit choppy, but the Dow, the NASDAQ, the S&P, they've all sort of rounded off. Even if they are going a little bit higher or going a little bit lower, it's sort of a flat top on each one of those. So around this time, I think that things could be very ugly. And if Jerome Powell comes out and says good things, we could see a nice little bump up. If he says about the rate hike, or if they see inflation being something they have to be even more aggressive on, or if the Fed comes out to appear more hawkish than we initially thought, then those are all things that could be really upsetting to the markets. I think that Jerome Powell is very conscientious of the markets, and I don't think that they're going to come out and say anything too disastrous during that time. I think that we're going to see a little bit of a bit of a sell-off Monday, Tuesday, possibly Wednesday that week, and then Wednesday when Jerome Powell speaks, I think that we're going to see a little bit of a relief where the market kind of settles a little bit, and we see a little bit of green that day, or maybe less red than we were seeing before. So I just want to share this chart with you real quick. This is the SPY, the Spider S&P 500 ETF Trust, and what we're looking at is the monthly chart. And when we look at this thing, you can see from here's March of 2020 when we really got into the pandemic, and you can see the big red bars that are there, and you can see the slope change that we have for this. Now, I don't think that it's going to correct course and be back where it was initially. I think that would be a relatively large drop in order to get back to those levels. There's so much more liquidity in the markets, and there's so much more money in the markets that just from the money printing alone and from the inflation that we've experienced, that some of this is actually to be expected. A 10% correction, while it would be very painful, especially for people who have high beta portfolios, a 10% correction, it could be understandable. I think that it is something that would create incredible buying opportunities that we recover from over time. So that's the S&P. The NASDAQ, where you have a lot of tech stocks, and tech stocks doing poorly when it comes to high inflation. A lot of people are hedging against those tech stocks right now, financial stocks, energy stocks. healthcare stocks, material stocks, especially with the high demand that we have. Commodities could certainly be some of those. So there are ways to hedge against it. Some people would look at protecting their investments now using protective puts. That's also something that you could do depending on how large your portfolio is and where you stand when it comes to preservation of capital. You have options, you have choices. There's things that you can do in the market. Some people will choose to move to a cash position and wait for that to go out. Some people choose to stay invested and hedge against with some of those more solid companies that aren't going to suffer as much under high inflation. It really just depends on your investment strategy. So let me summarize. Inflation for 2022, I don't think that it's going to end in any way like 2021 did with rampant inflation. I think that it's something that is going to pull back based on the data that I've seen and based on the data that I've shown you, paired up next to pretty much any time that we've had high inflation values were relatively low inflation values. And so since we had a straight up inflation, at least that it continued to increase in the year-over-year numbers all throughout 2021, I think that we're going to continue to decrease throughout the year-over-year numbers in 2022. And April's that first time that we had that big jump up for 2021. So I think that April's the first time that we'll have that big jump down for 2022. And any other time that you would see those big jumps, the Fed rate hikes, I think, are going to be a big part of that. The tapering that we have, I think, will be part of that. And the Fed unloading their balance sheet as they start to exit their position with their bonds, I think that that's something that's also going to, I think it's going to be an interruption to the markets. I think it could really drag the markets down a little bit, or at least slow the markets down. Those are things that we're going to have to watch out for, and stuff that Jerome Powell said that they're going to watch out for because they don't want to crash the markets. They want to walk that fine line between reducing inflation while keeping the markets happy, if you will. So that's what I have. I hope that you guys enjoyed this video. If you did, go ahead and hit that like button. And if you would, please hit me up down in the comments. Let me know what you thought of this video, other information that I should have included, other things that you would like me to talk about on this channel. I'm always looking for more ideas, and I always love hearing from everyone, and I try to answer as many people as I can. Also, down in the description, you have Moo and Webull, the referral links. If you haven't signed up for those, you can. Click on the links, sign up, deposit your money. You'll get some free stocks, and I get free stocks through the referrals. If you want to see more of what I have to offer, hit me up over that Patreon. I have my portfolios over there. The dividend portfolio has done very solidly. The growth portfolio, oh my, in this environment, it is not the time to be in growth, I'll tell you what. But when it does come back, I think that it will come back very strongly. So we'll watch that play out. I also have my crypto portfolio, and crypto is going to be interesting for 2022 as well. I better move on. Like I said, that link is down in the description for my Patreon if you want to come over and see more of what I have to offer. So thank you guys for watching this video, and if you made it all the way through, trust me, you are absolutely a true rock star. I'm Dr. Stock. Thanks for rocking with me. Now go get that money.